We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Coleman from Idaho Armored Vaults. Bob, always a pleasure to speak with you. How are you today?
Good, Tom. How you doing?
Excellent. Bob, I wanted to start by talking with you today about the silver market. What are the dynamics at play right now? You know, we're recording this on Tuesday, June 3rd. Yesterday, Monday, June 2nd, we saw a 5.5% up move for silver. So, you know, what is really causing this volatility, causing these bigger jumps and, you know, of both ways that we're seeing right now?
Yeah, you could say there's a number of factors at play. One is obviously Trump talking, you know, depending on which day he's talking and which ways what he's saying, it has a huge effect. So Friday night, the setup basically was last Friday night, I think he was speaking at a steel mill talking about steel tariffs increasing them to 50% from 25%. I think that caught a lot of people off guard. So then Sunday night, you're walking in when the markets all open up. The metals start to move. Copper's up big. Silver didn't necessarily move right away, but it started to gain sort of traction going into Monday morning, and it just started powering higher. What the setup was with that, I think, was, and I talked about it in a post the prior week, was the amount of short position that's built into the COMEX. There is so much metal that had been put onto the COMEX, not just on silver, but also on gold and platinum, for example, back in December, January, February, when the tariff issues and the explosion in the EFP, the exchange for physical premium, that the arbitrage between the futures markets and the spot price or the physical price. So what ended up happening back in the winter was a lot of people dumped metal onto the exchange because the premium on the futures markets compared to the spot market made it very profitable to put metal onto the exchange and then sell a futures contract against it. And so you had just a massive amount of metal coming onto the exchange. Well, what's happened is gold was the first one to normalize, and that you started to see metal coming off the exchange. Platinum was the next metal to actually, lease rates are still fairly high in London, but you started to see metal move out of platinum out of New York and go elsewhere. And then that started, sort of almost like a little squeeze on platinum, because then that took off. But what's happening now is with silver, the majority of metal is still there. What that basically means is guys that are short the futures contracts against that metal, there is so much metal, there's just too many sellers. And so as these sellers have been selling the contract, they've been killing that arbitrage premium or that EFP, that profitable premium. They've been killing that sort of level between the two futures and the spot price to a point where it makes no sense to keep that metal on the exchange. However, the issue you run into is we're on the July silver contract, which means if you've sold a July silver contract, you can't actually take delivery, for example, until July. And so the only way to unwind that contract before then is actually buying back that July contract and shorting, for example, a June contract. Well, the June contract is very sparsely traded compared to July. And so all of a sudden you have guys that are locked into positions that they can't get out of, and the prices start to rise to a point where now if you're short, your hedge is now maybe going against you, or you're having to put more capital in place to keep that hedge in place against maybe that physical position. That's one of the things. And that's interesting enough. We started to see an expansion, not a big one, but we started to see an expansion late last week into today in the EFP, the exchange for physical premium, between the spot price of silver and the futures contract. It started to reverse higher again. And that's a symptom that there's pressure on the futures contracts on the buy side.
So, Bob, how does this also lead into the open interest and the managed money positions here, and how has that evolved over, let's say, this year? We started the year with tariff talk, a huge run in gold and silver, and it was explained by people, trying to maybe get ahead of the possibility of tariffs on gold and silver. So how has that evolved through the year as well?
Yeah, it's been a roller coaster ride. Managed money was fairly long. Then you had these sell-offs basically wipe out, like, for example, early April when silver broke, went from 35 or 34 and a half down to 28 and a half or 29. You washed out a lot of longs. And managed money is, for people that don't understand this, they're the commodity trading advisors. They're the ones who manage money, but they do it on the futures markets, and they do it with leverage. And so they're tactically in and out a lot more. They're not really married to the position because they are dealing with leverage. So they're sometimes considered the weak hand. So when the market has big moves, they're almost stopped out of a position. So what you started to see was after, beginning of April, when the markets had this big drawdown, it wiped a lot of longs out of the market. And then all of a sudden the shorts, in a way, became the dominant position. And trying to get out of those shorts, you didn't have anybody, when you get out of short, for people who don't know, you're actually buying back your contract. But if you just had all the longs basically sell, there's nobody to sell when you're wanting to buy. And so the price starts to lift higher and you start to get this sort of very tunneled market. And that's what we've been seeing. This rise has been sort of relentless in a way, and very stubborn, especially for people that have been trying to call a top on the precious metals. It just, you haven't seen that type of, you haven't seen the enthusiasm that you would normally see at a top, because the retail environment has continually been selling back to the market, the physical coins and bars. And that actually, so you have a lot of different crosswinds going on at the same time. Obviously you have Asia and the purchasing that they're doing on the retail level as well as investment level. But this is where you just there's a lot more things to read here than just simply, a headline of, manipulation, or London's going to default, or China's the big buyer and they're just buying up everything. There's a lot that's actually that's going on under the surface.
Mm-hmm. Well, Bob, sticking with that tariff catalyst, let's say, that we had in January, do we have any visibility now into who those parties were that were bringing a lot of especially gold, and that ended up moving into silver? Who was actually bringing that into the U.S.?
The banks were the big buyers. They were huge buyers at the refinery level, taking as much as they could in terms of delivery. You had, for example, Asahi, which is a very big refiner, LBMA and COMEX approved refiner, basically closed down I believe their Miami facility that makes retail products so they could focus on the larger bar market, 1,000-ounce silver bars, 100-ounce gold bars, kilo-sized gold bars. And so you had a lot of shift of production to that larger bar market. And in fairness, you weren't seeing a lot of retail involvement for new product because there was plenty of secondary product, a lot of product that was being sold back. And that's typically cheaper premium product where a lot of precious metal investors will tend to go to first, to try and save money. And so you had this confluence of plenty of secondary inventory out there, and no need to make more smaller products out there.
But it was pointed to as a possibility that the Treasury or the Fed was, bringing some of this metal in. Do we have any indication that is even a possibility?
I guess anything's possible out there. From what it looks like, it looks like banks. It looks like that arbitrage trade was the dominant theme. I mean, there was an opportunity for the president's administration and the Treasury to make some maybe policy decisions or some policy arrangements. I guess using gold because so much gold was coming back into New York. But it seems like they've just kind of let that go. I mean, they released it, they made bullion sort of exempt from the tariffs. And so basically what happens is bullion will typically go where it's best treated, where it can garner the highest price or the highest premium. And that may be back overseas again. And that's what you've been seeing, for example, with gold. Silver, I think it just had maybe had peaked. We saw a massive drawdown last week of like 12 or 15 million ounces out of the registered category into the eligible. And you watch that's how metal typically flows when it's been put on receipt and starts moving back out of the COMEX system. It typically goes to the eligible category first, which is basically a private account. And then from there, it then gets loaded out and shipped out. So that's something I'll be watching the next few days or next few weeks. Platinum has seen a massive drop. Over 40% of the platinum that had been brought into the COMEX during up until about 6 weeks ago has now left. So you're already seeing that metal move out, and that could be from investment demand. It could be from fabrication, industrial fabrication demand, that type of thing. But platinum is a very small market. It's working off its above ground stocks. It's having the issues with supply constraints on the mining side. So you have this sort of perfect storm that's kind of forming.
Well, and you moved in to the platinum subject here, and that's something I wanted to get to. How much have we seen platinum go up over this year as well, Bob?
I think it's up about 17 or 15%, something like that. I mean, it's had a nice run. It's something that I've been in front of. Full disclosure, I run a hedge fund. It's in precious metals. Now I can't say it's just gold and silver anymore. I started to take a position in platinum. I was very open with that on X back in March. And so to me, when I think I bought it as low as when the gold to platinum ratio was at 0.28 on that ratio, meaning it took more than 3 ounces of platinum to make out 1 ounce of gold, which I don't think we've ever seen that in human history before. Platinum is typically 20 times rarer than gold. And I get the idea that electrification and that type of thing for cars and so forth was sort of a dominant theme that kind of curtailed the use of platinum and palladium and catalytic converters over the last couple of years. But now people are understanding that the electric car market, especially in the US, may not be as dominant as everyone had thought because getting the parts and so forth, and weather has a big impact on range out of a battery and so forth. People had gone back to internal combustion and hybrid engines, and the government last year made an effort to actually encourage, I guess, the use of hybrids. And so that started to lay a foundation for platinum. And plus, platinum on a technical chart has been in this pennant formation of the last 5 years, which the apex comes in 2026. And we also have an apex on a 50-year chart with a rising uptrend line and a downtrend line from the highs back in the mid 2000s. That's also coming in at apex literally in 2026 again. So there's a big move that's coming with platinum. Obviously the question is which way, but to me, it seems like with the supply constraints that we have from the mining sector, the working off above ground inventories. I've seen research that basically says anywhere from 2027 to 2029, those above ground inventories will be completely worked off. And then you're going to be in an actual deficit with platinum going forward.
Mm-hmm. So Bob, going back in a way, but I think this applies to all of these markets that we've kind of touched on here. How could these big short positions end up leading to a constrained physical supply here?
Yeah, it's more of think of it as a squeeze, like a short squeeze rather than constrained supply, because there's plenty of metal on the exchange. I'm not saying that we're running short on metal. It's the price of which the short positions can unwind that hedge. And you have to remember, if you go back to 1980, from what I was told in 1980, what took silver from 35 to 50 was actually a mining company that ended up blowing up their hedge book and running silver from 35 to 50 very quickly. And then if you look at the 2011 timeframe, what moved silver in April was basically the contract roll or the May roll, people getting out of the May, the short position that they had built in place there. So the futures markets can create this sort of derivative style environment that can actually push prices around that may not have, this like complete drain of physical metal, on a physical level. It can just affect prices, and then of course you get back to this equilibrium. The obviously the big question is going forward. Will we see that? But also, is the physical metal actually becoming more dominant from a pricing standpoint, which I've always thought it is. We're seeing this sort of deleveraging that's been going on since the Basel III announcement back in 2022. You've seen maybe more OTC activity, that type of thing, or I'm sorry, more activity going onto the exchanges. But there's been less derivative usage. Like, for example, Goldman Sachs has completely closed out, I think they're pretty much their entire derivative book on precious metals, that's reported to the Office of Comptroller Currency. So there's a theme that's going on that as long as physical, that's where I kind of, in this post that I talked about last week, the next chapter of this event is physical demand. Will physical demand start to actually pick back up and not really be defined by the arbitrage premium between futures and spot anymore? Will there actually be true investment demand that says, we're worried now about the dollar, budget deficits, Fed coming back into the picture with QE, whatever it may be. Because it really obviously looks like, with this big, beautiful bill, we're going to get a big, beautiful spending pattern as well. So I don't think that's going to change. So these are all things that I think will be supportive of metals.
Despite the promises to reduce deficit spending.
Yeah. And unfortunately, I think we're just in a position, and I've said this before, not to be political on either Democrats or Republicans. It's just, we're stuck in a fixation of inflate or die. I mean, that's a fiat driven model that ultimately there's no way out of it. And ultimately the currency becomes the sort of the release valve of all the pressure. And that's why, again, owning physical metals, with that, having that, owning it held directly, that type of thing, without, the counterparty risk and the systemic risk issues that you may have when you're storing with a structured program or a dealer or something like that. The idea behind it is that you're putting yourself on a gold standard.
Mm-hmm. Well, and I mean, you said basically an inflate or die is the only option, and central banks never ever take the deflationary option, which is basically defaulting outright on their obligations versus let's say stealth default, right?
And that's the scary thing about conflict and war. When things start to get really rough, a lot of times war comes into the picture as an excuse or a deflection off of all the excess and leverage that we've created in the financial system, during a peacetime. It's just, humans tend to, repeat or, the behavior over time. And that's what, obviously you see the conflict with Ukraine. That's why Ukraine is so important. I mean, you just saw a massive hit on strategic bombers in Russia and so forth. Are they going to sit by and watch, their Pearl Harbor style event go, unreacted, or are they going to do something, that sort of gives them pride and as a nation and defend, their sovereignty and so forth? These are the things that, the realities of the investment world we're in today.
Well, and I mean, unfortunately, I'd love to just focus on only gold and silver and the market dynamics within it. But, geopolitics, these macro events, cycles as they were, there's all of these things that play into the markets that we unfortunately can't really ignore. We have to have a decent grasp of all of them to understand or to get a clearer picture of where these markets are actually heading.
Yeah, definitely. And with understanding that picture, that's where you start to strip out the risk scenario. That you start to understand, okay, what is systemic risk? What is counterparty risk? What is, because when you're buying metals, for example, that's an insurance policy in a way. You're taking chips off the table for that potentiality of, hey, listen, the dollar starts dropping because the spending doesn't stop, and the Fed comes back into the picture, and they start cutting rates, which actually may accentuate a down move in the currency, and it may start lifting inflation at a time when the economy may be, somewhat stagnant, and we haven't really seen that kind of picture in quite some time, and that I think, we live in this world of algos and computerized trading and AI and so forth. And, that tends to take over, it seems like, the day-to-day trading activities, which is kind of scary when you think about it. They certainly don't have any experience. They're just reading code and reacting to, certain formulas or code that's been written into that investment model or thesis. That's the part that, things can go awry very quickly. And when you throw leverage on top of that, and then you have the U.S. government, which is going to be coming to market with a lot of debt this summer. The Treasury General account looks to be completely drained by mid-July or so. And they're getting ready to, that's when the deficits start building back up, and the debt ceiling is probably going to be lifted, and there's going to be $800 billion probably of treasury debt sold into the market. Is that going to be absorbed by the general market, or is it going to be, the Fed coming back into the picture being the buyer of last resort? Those are big questions, which could have, this added volatility.
Mm-hmm. So, Bob, I want to go back and just touch on one more piece of the platinum story here. Was platinum exempt through the tariffs as well, or did that only apply to gold and silver?
It's a great question, because when I was buying platinum in March and April, there wasn't a lot of platinum to buy unless you're trying to go to the exchange and buy the 50-ounce plates, for example. But with platinum, some of the refiners that I was buying from, the concern that they had initially was bullion. Yes, bullion was listed as exempt, but it wasn't really put into the harmonized code section. So it was this ambiguity that kind of was created. Platinum is obviously an industrial metal as well. And so, it may not, there was concern about trying to bring a lot of platinum into the country, and then all of a sudden, either the exporter from outside the country would be hit with that tariff, or the person that was taking delivery of that would have to cough up the money and pay that tariff. So that ambiguity seems like it's kind of been lifted because this delay and so forth. But then you have this, after the 90-day delay, you have a 10% tariff all over again. I mean, there just seems like it's like on again, off again, and who knows if I wouldn't think if they've walked back the tariff concerns and they made bullion exempt. I guess it would be extremely shocking if they put, this threat of tariffs on everything all over again. That would be total chaos if that happened.
Mm-hmm. One of the other things that I wanted to ask you about today, Bob, is something that you and I have touched on over the years. In some ways, it's a very boring subject, but, this summer, or I believe it was July, was supposed to be the implementation of these Basel III regulations for the banks, making gold a tier 1 asset. So this has now been delayed. Why don't we start with, what are the important details to understand about why and who delayed the implementation of those regulations?
Yeah, and Basel III is not just about the precious metals markets. It's about numerous asset classes and debt markets and so forth, and the sort of the margin or the amount of capital that you have to put up against a position that the bank is taking on the other side. So, relating it to the metals, for example, back in 2022, Basel III came out and made it sort of punitive for a bank to have an unallocated precious metals position. Basically, what they do is, say a bank client says, I want to buy gold. The bank says, listen, I got this great investment that you can buy gold. You don't have to pay any storage fees. And when you want to sell, we'll buy it back from you. And so people are like, that's great. Versus an allocated a position where they buy actual physical metal held, the client does, buys physical metal from the bank, holds it in their name in the bank vault, for example. So what ended up happening was, in the unallocated scenario, the Basel III restrictions said, listen, if you're going to do that, that puts more risk on the balance sheet of the bank, because the bank doesn't necessarily need to go out and buy gold to back that exposure. They can use the balance sheet of the bank. Well, you had to increase the reserve funding rates of up to 85%. You had to cough up that money, whereas in the past you didn't have to cough up anything. You could just write as many of these contracts to willing buyers. Well, that started to restrict that unallocated position and made it sort of made it a little bit more unprofitable to get involved with. So you started to see that sort of unwind where the bank trading desks started to constrict. You started to see some banks pulling out of the market, reduction of activity, especially here in the United States, for like HSBC, that type of thing. But now, and I haven't checked. I know the full implementation of Basel III was kind of delayed, I think, on the U.S. side as well as Europe. So I'd have to kind of look into that more specifically on the metal side. But I think it had to do a lot, obviously, with the treasury market, the debt markets, this bulging basis trade that the repo markets were funding when Yellen basically front loaded all this treasury debt into T-bills, basically, because it was easier to sell into the marketplace, and the banks could loan against that much easier as well. But that basis trade has sort of been unwinding, and that's why coming into this summer, I don't think the Treasury is going to have an easier time like they did with Yellen, just selling a bunch of T-bill, 1 year or less maturity paper. Because I think those animal spirits of taking hedge funds, buying that T-bill paper, and then lending it or borrowing against that to maybe their prime broker or a bank, and then going into the market and buying something else with it, or just saying, listen, I'm going to hedge with futures contracts and that small little basis trade spread between the futures contract and the actual note itself. They make a lot of money off of it when they're dealing with the leverage. I think that game is done, and that's where the next evolution is stablecoins. And stablecoins, I know we've kind of talked about this in the past, but stablecoins, I think, have been brought into the picture to be the buyers of treasuries. Tether is, I think, the fourth largest or fifth largest U.S. Treasury holder in the world. I
thought it was 16th or something.
No, it's gotten a lot bigger, but
okay.
It was 11th last summer when Howard Lutnick was talking about Tether in the Bitcoin conference. I think it was in July, but it's definitely grown. It maybe not be fourth, but it's big. But the stablecoin scenario is being brought about to actually support the treasury market, because they become the buyers of treasuries. And unfortunately, a lot of the people in the Bitcoin world who bought Bitcoin maybe because they wanted to hedge themselves from the US dollar and the financial system, they are now tied at the hip with the US Treasury market, unfortunately. And that's where I think that's a theme that hasn't really been talked about a lot lately.
So what are the broader implications, or maybe explain what you mean by the being tied at the hip to the treasury market?
Well, the stable coins are sort of a dollar. They're kind of like a private money market account, if you think of it that way. They're an unregulated money market account. So, those things are pegged at $1 a share and doesn't deviate. Well, in the stable coin world, you're putting your money into something. You may not get any return on it. You may it's a parking spot. Think of it that way, that it's backed by the treasury market. As long as the T-bills or whatever it's invested in is fairly stable, it acts as a on and off runway into the current banking system, and then also into the crypto world. Well, if the treasury market becomes disjointed, for example, and all of a sudden that link of $1 per unit breaks, for example, and all of the stable coin goes from $1 to 90 cents, there could be a lot of panic that ensues from that, where people are trying to get out of that stable coin and maybe get back into a legacy product, so to speak, or they could throw it into Bitcoin. But the problem is there's a lot of leverage based around these stable coins that act as anchors. And like Tether, for example, they purchase a lot of Bitcoins. So and they're not audited, which makes things even worse. They've never actually put out a full financial audit. So the problem you run into is any volatility or unusual unwinding that starts to happen for selling, for example, the stable coin may be forced to sell underlying assets at prices that are permanently at a discount to where it would normally need to be to keep that fund at $1 per share.
Yeah, I'm just looked something up here. The chart that I saw earlier today was 16th largest holder of U.S. Treasuries, and then I just found another piece that was in October 23. They were 16th largest holder. So Obviously, it's grown since then, right?
Yeah. I saw an interview. I forget the interview. It was, I think, today or yesterday. They had mentioned Tether is number 4, but either way, Tether is a huge owner of U.S. Treasuries, and so the idea behind it is any unsettling move in that market, which is completely unregulated, from the big players out there like Tether, can have a huge impact if you start to see a break or demand and saying, listen, I don't want my Tethers anymore. I want cash, or I want, whatever it may be. I want to move that outside the crypto world back into maybe something directly, where I buy US T-bills directly. I don't want to go through a middleman anymore. Those are the things that you have to be concerned over. And if that happens with Tether and they're a huge owner of Bitcoin, what happens if they have to start selling assets across the board? Those are that type of unwind can happen.
Yeah, I guess it's a risk that I guess I can't say that we haven't seen, because I don't know that for sure or not that Tether has, let's say, gone back into the market and actually sold treasuries at any point. But I assume that has only been a one-way trajectory up until this point.
Yeah, definitely. And there was actually, I believe, Howard Lutnick talked about this, I think, in a speech or where I think it was Sam Bankman-Fried bought a bunch of Tether and was planning to dump it all at one time, trying to disrupt and break the Tether price. And I think Howard Lutnick's firm, Cantor Fitzgerald, stood by and bought all the treasuries that Tether needed to sell in order to maintain an orderly market. I believe that was talked about in an open forum last year. So there is a lot of players that are trying. Unfortunately, that what we think that's happening in the financial markets isn't always what we know. I mean, there's other players that are wanting, for example, crypto to do well because it actually may benefit the U.S. government and the treasury market, and allow another buyer to come into the picture. Whereas a lot of people that buy cryptos thinks this is great because I'm outside the system and nothing will affect me.
Yeah, outside the system that you're trying to stay away from, but yet the liquidity in a roundabout way in that system is also driven by demand for treasuries, right?
Yeah, exactly.
Mm-hmm. Bob, another interesting story I kind of came across recently was the ECB warning that the gold markets are a risk to financial stability. So in some ways, does this have some of the same, symptoms of what we just talked about, where there is a lot of leverage within these systems, and that's where these risks are now present because of that leverage?
Yeah, I talked about this a couple of years ago with the European markets. They're very unique in that they have these regulations that force institutions into these ETFs that are actually ETFs that you can't actually take delivery of metal from. They're more of a derivative based instrument, and their support. The derivative instruments are well supported in Europe because the idea was back, I think, in the 90s when they created this. It was the idea that the banks could provide a much more liquid market for derivatives than they could the actual underlying commodity. And so you have this enormous amount of activity that goes into commodities across the board that are actually in derivative models, or even the electronic traded notes, for example, which are debt instruments. These are the things that a lot of people may not understand outside of the United States. In the United States, we don't really have that model. For example, if you had, and I talked about this, if you were a European fund and you own PSLV, you cannot actually take delivery of that physical silver. There's constraints that you have, staying within the rules of all the regulatory items over in Europe.
Mm-hmm. So it's more so about just this chain of leverage, really, within that setup, right?
Yeah, it was designed, I think, to provide this, I guess, support to the financial system more than it was support to the individual commodity markets in general, which is unfortunate because obviously that's created, this large amount of counterparty risk and systemic issues. And that's, I think, what their report kind of portrayed.
Mm-hmm. Bob, you and I have spoken many times regarding basically terms of service agreements when storing metals or using any pooled programs. And one thing you posted recently was the terms of service for storing metal at the Royal Canadian Mint. And the obvious line that stands out to me is that they aren't responsible for an act to privatize the mint by the Canadian government. So do you see this as a possible risk and something in any and all of these agreements of storage programs to make sure that you understand?
Oh, totally. I mean, that actually language came from the prospectus that the Royal Canadian Mint, they put out an ETF. I think it was a gold ETF back in 2011. I think it was. That language came right from that prospectus. And so it's not something that you try to drum up to fearmonger. I mean, these are realities of how all these structures are set up. And that's why I keep telling clients and individuals out there, make sure you read the terms of service, make sure you read the risk disclosures, the storage agreements. Like, for example, you're seeing a lot of, in the US, a lot more arbitration style type clauses where they're waiving, you waive your right to a jury trial, you waive your right to a class action status. These are the realities of an unregulated market where the sponsor or the structured program is trying to reduce as much risk to themselves while pawning that risk back onto the customer.
Mm-hmm. Yeah, it's just quite a thought that there's so many of these scenarios that you aren't covered for. But do you actually see this as a possibility of Canada going back and nationalizing the mint or nationalizing some of these storage programs?
Well, I mean, they're a fiat-driven currency as well. I mean, the tough thing about a fiat world that we live in is, people don't ask questions until everything hits the fan, and then when that moment hits the fan, everything changes. And if we're talking about a financial system that's shifting potentially, whether it's going to Asia, for example, or if it's just deleveraging, well, the problem you're running into is like these currencies are the release valve for all these countries. It's not just simply the U.S. It's what stops Canada from printing more money? What their policies to try to spend more money than they're actually receiving. These are the realities of geopolitics in general. We're sort of in this economic Cold War where whoever can kind of spend more than the other guy, maybe either more capital flows to them because it makes this picture of economic activity maybe more impressive. But there's an ultimate cost to this at the end of the day. And with Canada, the unfortunate thing is they have no gold or silver in their foreign financial reserves. And so to me, that's a huge red flag. Whereas at least, the US has supposedly 8,000 tons of gold sitting in Fort Knox and other mints around the country.
Mm-hmm. So Bob, what are you seeing from the physical bullion demand side of things? You obviously deal with customers on a day-to-day basis. What are you seeing from, are you seeing a lot of metal coming back still? Has that kind of abated? Are you seeing more demand on buying? What are you seeing there?
Yeah, think of it almost like a sail ship in the middle of the ocean when the wind stops. I mean, that's basically what has kind of transpired with, you get pockets of flurry. You get, the geopolitics starts to, that comes into the picture very quickly. And all of a sudden you get buying that comes in. But as prices go up, the industry has been seeing constant selling. People that have been in this market a long time saying, hey, listen, I'm going to take my profits. I need income. I'm going to, invest in, maybe, a house or something for the kids or pass it down, whatever it may be. They may have bought metals 20 years ago, so their lifestyle has completely changed. But what's happened is the new minted products are not selling because new minted products have this sort of fixed higher premium that the refiner or the minter charges the wholesaler. And then the wholesaler has to mark it up and he has to sell to a retail dealer, and the retail dealer has to mark it up to sell to a client. Versus the secondary market, which is the used market or what they call prior years or backdated type product, where you're selling back a 2011 Gold Eagle, for example. You're not having to get pay the mint's price to make the Gold Eagle. There's more of a tighter spread in that market and then based on market conditions, that premium goes up and down. So right now, the premium has been collapsing where a lot of wholesalers are paying discounts to Gold Eagles right now when people are selling back. That's how many Gold Eagles are being sold back into the inventory of these wholesalers. And that's telling you, and premiums are very low, for example, on a lot of products. And if you go to the bid side, when you go to sell back, you're seeing very big discounts to spot amongst the retail dealers and the wholesalers. So it's telling you that there's too much inventory and they're very inventory heavy at a time when the wind's kind of coming out of the sales and you have carrying costs, you have hedging and so forth. And the dealers and the wholesalers which hedge may use futures contracts, and all of a sudden you got the volatility of the futures markets, and if you have this reversal of premium and the EFP starts to rise in the contango when it should be falling, that's a negative that means your futures contract is going up faster than your spot price. That's a potential mark-to-market loss there, and that has impacted a lot of players this year.
Yeah, it's pretty crazy to think about where the industry is at, where the retail buyer is at, despite basically record high gold prices, silver being the highest it's been for quite a long time, and like even what we touched on with platinum earlier. There is excellent price action, but the West really doesn't seem to be participating or having any on the retail side, it's not really participating, right?
Yeah. Now, to be fair, a lot of the buying that has come in has been larger purchases by higher net worth individuals. You have players that say, listen, I don't have any metals whatsoever in my portfolio. I've been a stock guy or a mutual fund guy for the last 20 or 30 years. I recognize the risks that are building within the system and the tension that's out there geopolitically, or the trap that the Federal Reserve has kind of caught itself in with. Are they lowering rates? Are they raising rates? Is the U.S. government going to borrow more money, spend more money, whatever it may be? And so you are seeing the purchases. Maybe the average transaction is much higher than it's been in the past, but there's just a lot less tickets being written. If that kind of helps put it more into play. So there is metal being purchased. It just, you don't have the retail engagement, which makes this interesting, because then the question is, a lot of people are calling tops in the metals. And typically when you see tops, it's usually when the retail is kind of FOMOing into the market, fear of missing out, and, just euphoric. And you haven't seen this euphoria for the last year and a half, which is something I've been touching on literally since the Silver Symposium, I think in 2023. It's been, yes, we do get these bumps in price and gets people excited, but other than that, things settled back down actually fairly quickly.
Mm-hmm. Well, I think one of the pieces of your talk that you actually had in the Silver Symposium there, Bob, was the idea of manipulation. We hear manipulation within the markets ad nauseum, right? So how do you define manipulation?
Yeah, I kind of keep it as simple as possible. I look at manipulation versus management of the markets. Manipulation has sort of this ill-fated intent to deceive and coerce and basically steal other people's money through fictitious trading, that type of thing. It's different from spoofing. Spoofing is more you're posting a price, you're taking the price away, but you're not. There is a difference between manipulation and spoofing on a legal sense. Now, a lot of people say, well, what's the difference between all this stuff? Because the prices get squashed every morning and they never go anywhere. And, gold and silver should be X higher than where it is currently based on money supply or other types of measurements. And that could entirely be the case. I look at this as the entire system is managed. It's managed in a way for the benefit of the financial system and the U.S. government, because, hey, listen, we won World War II. We get to make the rules. And part of that, of maintaining this sort of strong dollar policy is, yes, there is some management of the price action of the metals. But if you look at gold, for example, it's up 10x since 2000. It is going up. And silver, for example, is rising as well. May not be rising as fast as people want, but you think of it this way: you're using the manipulation or the management to accumulate those metals at low prices. Because if we're all right at the end and metals, silver does take off, you've had that much more time to accumulate your position. And yes, it's a frustrating event, but you have to remember, between 8 and 10 in the morning, when the New York markets open up and so forth, you have the confluence of the London fixes, the silver fix at 7 in the morning London or New York time, and then the afternoon fix with gold. So you have a lot of buying that goes on over there, and then hedging of that physical activity over in New York. And so those markets will have this sort of two-way action that kind of corresponds with each other. And if the patterns were such that everyone could figure this out and say, well, God, between 8 and 10, all I have to do is short at 8 o'clock in the morning, cover at 10, that would actually negate that pattern faster than anything. So it's one of those things. That's why I own physical, because trying to get into the nuanced day-to-day activity will drive you crazy. You're just dealing with too many different players out there. You're dealing with leveraged traders, you're dealing with CTAs and commodity trading pools, you're dealing with hedgers, you're dealing with miners, you're dealing with fabricators, you're dealing with wholesalers that are trying to protect their pricing or their inventory and profit model. You're dealing with retail dealers that are trying to protect their profit model. So, every ounce of silver that gets pulled out of the ground may get sold 5 times before it gets to its end user, because as it goes from participant to participant, they're trying to protect from the volatility of that price. So it's just the nature of the beast. And, it's a small market. Platinum is even much more smaller than silver is. So you have these, you have to be aware of not getting your entire profit center wiped out on, some geopolitical event or remark by the president's administration, that type of thing.
And Bob, you did a bit of a study on this. Who has the most impact within the silver market from a market movement standpoint?
The players that you have obviously industry is about 70% of the market, but the investors tend to actually move the price at the margin, if that makes sense. So what you've been seeing, like for example, in 2008, when the market fell out of bed, you had the silver ETF see an enormous amount of assets coming into that fund during that big downdraft from August into October of 2008. But at the same time, you had the futures markets see a complete wipeout, and the futures markets tend to have this pricing power over the overall market because you're dealing with leverage. You're dealing with players that can't afford to deal with the volatility. There are stops in place. They're what they call when you see big moves in either direction, up or down, those are stops being run, and that tends to impact the pricing of precious metals more than anything. Now, some of the advantage that we've seen, obviously, with this year with the tariffs and so forth, is that demand of physical and increasing lease rates, increasing carrying costs, and so forth, putting pressure on the physical market actually was one of the big benefits of moving the price. So you can have where the price starts to get impacted by the physical markets, beyond the futures, some of the arbitrage and so forth, the pricing and some of the exchange for physical premiums and that type of thing. But the futures markets definitely have a big play in this. Unfortunately, the futures markets are designed to be a seller's market. They're designed to be a hedger's market. So we kind of base this price model off of a market that's really designed to be a seller market, not a buyer's market. And I think that's the most frustrating thing that a lot of physical metal owners are trying to understand. Whereas the physical dealer world, retail dealer world, wants you to think that, that's just a manipulated market. It's the banks always selling into the market, driving the price down. But in reality, there's a lot of players that participate in that futures market that are selling to just basically protect their physical inventory.
Mm. Excellent, Bob. Well, is there anything else that you'd like to maybe leave our listeners with to think about that's on your mind at this time?
Yeah, to me, just if you're a long-term owner in the metals, try to look at the bigger picture, not get caught up in the day-to-day sort of swings in the marketplace. We're all buying the physical metals more in a longer-term type of picture. Obviously, you don't know what any administration, either domestically or internationally, is going to say from day to day, or what world event may happen down the road. But the idea is, I think, you still have the wind to the back of the precious metals. There's still a lot of anxiety. There's a lot of geopolitical tension and so forth. And I think larger high net worth players are still looking at this sector as a bond alternative, as well as a hedge for their traditional portfolio.
Mm-hmm. Yeah, that's a great way to put it, Bob. So for those that want to know or to read more from Bob, of course, excellent Twitter follow at Profits Plus ID. You post a lot of stuff there and post a lot of charts and a lot of relevant information that is very sober and I think always very, very timely. And of course, you're also available at goldsilvervault.com. Bob, thanks so much for your time today. I always appreciate.
Sure, appreciate it, Tom. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.